Okay, this is a market review for the Nasdaq on the 18th of September. We're going to be going through the London kill zone and the New York AM kill zone. So here, because we've just finished the silver bullet mentorship, I think it makes sense to refer to a silver bullet. So in the London session, we put in this low after the 3 o'clock hour, so it just happens right at 3 o'clock. We allow ourselves from 250 to 410 when looking for silver bullet setups, but the liquidity sweep here happens right at 3 o'clock, which is nice. It sweeps that liquidity, goes into the fair value gap, rallies higher above this high. Now, it does that with just a wick, just a little wick. It trades above it by just a tick, and then that acts as a market structure break. That's what MSB stands for. Why is it a market structure break and not a primary market structure shift? Because of the energy that was used when it displaced lower away from that high. So then you can take an institutional overflow entry drill here. You can extend this fair value gap up, you can use that one. But if you weren't confident enough to get an entry there, then you could have used this fair value gap, this order block, this fair value gap, this order block, these order blocks. Now, that fits our definition for bullish order flow. When down close candles are supporting price higher, meaning when we trade above the down close candles and then we retest that level, like we do here, it should support us higher if it's bullish order flow. And then every single occurrence of down close candles, when we trade above it, it gives us that support level to go higher. And here we have the last fair value gap going into the London, the end of London silver bullet, and then it consolidates. You could have projected this range in the London session with the fulcrum, so you could have done this, and you could have used 2 standard deviations, or you could have used 2.5, so you could have used that. Typically, you want to use 1.5 and 2, and then 2.5 is something that it can reach into, but this is all-time high conditions, so you would look further than that. Okay, then coming into the pre-market hours, I'll cover my trade, and then we'll go to the AM kill zone. Now, in the daily analysis this morning inside of Discord, I did say the pre-market should trade into the London range, and then going into the New York AM session, I didn't make any calls because I was busy, but I did say in the daily analysis that we should trade lower into the London range. I got that because of my analysis on the dollar, so you can look at the dollar and see that if you want. But we sweep out this high, see that? And then we displace back lower, and that leaves these inefficiencies that are overlapping. So those are balanced price ranges. We leave those there and we don't trade back into them. That's an important sign because it basically confirms the idea that we're probably bearish and heading into the London range. So once we leave the balanced price range, it was pretty easy to identify that that would be isolating anything above this level. Everything above here now, it can wick into the first balanced price range. I wouldn't have minded that too much, as long as it didn't come into the higher one. Anything above this is now become isolated. The balanced price ranges have basically locked it off. So I got into 5 minis, and then I closed them here. There's a bit of slippage, I guess. Oh no, it's my partial. I had a partial at this low, and then I had the last portion of my trade came off at 2 standard deviations. Now again with fulcrums, I measured from this low to this high. What does this look like to you? This is a breaker block, so we have a high, a low, higher high, and a lower low. Once you trade below this fulcrum level, that's when the standard deviations become effectively valid. That's when you're starting to look for them to deliver. So am I looking at them up here? No, but when we trade below that level, that's when I'm expecting it to further distribute into these levels. And notice that I'm not trying to pick out the lowest low or the highest high ever with standard deviations. I'm just using them as something I can further extend my trades that win. So my winner could have been just there, and my partial was at that level. A little bit of slippage, but my partial was at that level. I extended the amount of handles I was able to capture with the use of the standard deviation. If I wasn't using that, I would have not captured the extra 13 handles, and it would have been, 13 handles less profit. But by using standard deviations, I can effectively just make my winners slightly larger. I'm just using them to give myself an expectation of where it's likely to distribute. There's no fancy technical tick-to-tick precision here. That's not what I'm aiming for. I'm just using it to get a gauge on how far price is willing to go. But it does bottom out for a while, but then coming into the open, we trade lower and we fall short of the consequent encroachment of our regular trading hour gap or our opening range gap. That's a good sign of strength because we're failing to fill in some key levels there. And we also trade into a 5-minute fair value gap inside of the London range, and we reject that. So we just dip below the midpoint of that, and then we reject it. Again, like we had earlier, we displaced away from here, leaving a balanced price range. Now, what's inside of this balanced price range? Breakaway gap. That's a breakaway gap. What do I teach about breakaway gaps in the mentorship? The free mentorship, the silver bullet mentorship. They effectively mean that you're likely to keep trading higher at a faster rate and hunt a higher time frame liquidity pool, like a 5-minute or a 15-minute liquidity pool, or something where the major buy side would be located at. So that would be here, and that would be all-time highs. All-time highs was there. So then it trades above the market structure shift with displacement, and it seeks a short-term discount. When you displace above a market structure shift, you're not always going to get that short-term discount. Sometimes you'll just keep going and keep going. So on a displacement above market structure shift, sometimes I'll enter a smaller position, like half of what I want to enter, and if it does come into that discount level, I'll place the rest of my trade. But if I don't want to miss out on the move, I would have entered when this candle was like there, about half of the position size. But then if I was to add the rest of my position on when it reached into discount, it would be on this fair value gap there. Again, I wasn't trading the New York AM session, so I was just eating. So this bounce price range and the breakaway gap, that gives you the, not confirmation, but it gives you the confidence that price shouldn't trade back into this level. It broke away from that range now. It's got a market structure shift. It can seek a short-term discount like it did, but we really want it to, start breaking away and trading higher. But after that retracement, it comes back into the inversion of our first presented fair value gap, and then it gives us another market structure shift, secondary one, and then trades back into the first presented fair value gap. But notice this time it doesn't go into the consequent encroachment level. It stays above the midpoint. So once we trade above it and it becomes an inversion gap, trades below into the upper half of that gap. And then it keeps running higher and higher and higher inside of the macro. So this is the 950 to 1010 macro, I should say 1010, not 1110. That's typically going to be the distribution macro when you see those algorithmic footprints that I keep droning on about in the silver bullet mentorship. Well, when did the injection of volatility kick in? Exactly on the macro. Exactly on the macro. Before that, it was just giving you the story, and then the footprints started to come in during that macro. So it just goes to show how important these macros are. Because you have an underlying bullish bias of trading into this high, because we're in all-time high conditions for bullish, right? It gives you that retracement when it's looking like it's going to displace higher. We can measure that retracement again, like we did earlier. We were underlyingly bearish. It had a retracement. That retracement was in the form of a breaker block and a stop hunt. So it's a little bit different. This is a mitigation zone or mitigation block. But it still functions the same. We look at 2 standard deviations, 2.5 standard deviations. It does reach into both of those, so that's a distribution expectation. I'm aware that most people in Discord actually did catch that long here, so I'm very proud of everyone for doing that, and there was tears running down my face every time I saw someone post any winning trades. Putting the New York AM high, coming to the macro. This is the 1050 to 1110 macro. If you've had a large one-sided move inside of the first part of the AM session going into the 1050 to 1110 macro, you're likely to get some kind of retracement that goes against the one-sided move that occurred in the AM session. So we put in this high, we start retracing prematurely. Going into the macro, we get that last little bit going into the order block. Then we kind of meander around, accumulate, gives us these lows. Short-term sell-side liquidity sweep going into the 5-minute fair value gap, and then you could have got a nice long there. But again, it tapered off, started consolidating. So the majority of your trading should have been done in the London session today, or the pre-market session, or the AM session after that. Are you looking for trades in the PM kill zone? Typically you wouldn't, because we've already worked most of the available range that we have already, like within the London session and within the AM session. Now that's not to say that PM session is going to be shit, but you lower your expectations for this because you've already done so much work on both sides of the range with the AM kill zone. Plus, we made a lot of smooth edges at these lows jagged, and we also made this high jagged, so there really wasn't that much to take, except for this. I bet some people tried to take a long going into these consolidation highs, but there really wasn't any good bullish market structure to take that on. If you were really zoomed in, this is a mistake a lot of people will make. They would see something like this, but because they're so zoomed in, they would see this as a market structure shift and a fair value gap. And although it technically is both of those things, taking a long there, it looks like it makes sense here. But then when you zoom out a little bit, like this, it's like, that would make no sense. Why would it reverse from there if it's got this sell side that it probably wants to take, it hasn't reached into the gap? There's so many things it could do on the sell side that I wouldn't feel comfortable taking the long there, even though it's the pattern. It's within the time zone that we look at for the PM silver bullet, but there's not the narrative behind it. There's no real good liquidity sweep like I would have wanted to see something like that swept. It wasn't swept though. So there was a silver bullet inside of the New York AM session today and inside of the London session today. If you were trading the PM, I'm sorry to hear that because you would have sat through a lot of dust. I can see a decent trade here. You could have taken a silver bullet sell there, but I wouldn't have recommended it. It's kind of out of a consolidating environment. We've already done most of the work inside of the daily range, or for the daily range in the AM session and the New York or the London session, so it really wasn't ideal to be looking for anything after the AM session had concluded. But that's it for this market review. Hope you found it insightful. Thank you for watching.